Start by opening our books to accounting for the issuance of shares, or basically the concept of par value. Either of those may be exactly where you need to start. It's either going to be about the concept of par value or accounting for the issuance of shares. When we talk about par value, basically we're talking about issuing shares at par. And what does that kind of remind you of? It reminds you when we talked about long-term liabilities, when we talked about issuing bonds at face amount, okay? So anytime we issue stock, we're going to issue it at par. But what does it mean to issue stock? Well, it's the same thing that we talked about pretty much last time. All assets, when you buy an asset, either you can pay for it, quote unquote, out of your pocket with your own money or with your own equity, or you can pay for it by getting other people to invest in you, okay? So last time we talked about a creditor type relationship where we get someone else to pay for things, okay? Now what we're looking for is basically selling a part of our business. So stocks, when we talk about issuing stocks, we're talking about selling a portion of our business in order to raise capital, which is not a bad thing. If you quote unquote own 80% of a company and you need 20% people more to come in and help you keep your company going, that's pretty good other than going out of business, right? So that's the way we want to think about it. Issuing stock is the same as giving up a portion of our ownership to say that, hey, we can stay in business or we can expand, okay? So when we talk about par value, the whole concept of par value is not anything new. As a matter of fact, it's pretty old, so old that a lot of people don't use it anymore, okay? It's nothing that we deal with here in terms of why it's, you won't see anything test-wise in terms of why you'll be having par value, but what you will see is that all stock is automatically issued at par value, whether it's common stock or preferred stock, all right? So that's what we're talking about when we get to talking about the the accounting for the issuance of shares, okay? Right under you see a section called shares issued for cash, correct? All right, let's look at this brief example here. Dow sells 10,000 shares of his common stock at $1 per share. Now, we already know that cash, you always debit cash for whatever you receive. There's going to be a portion in this chapter where we're going to come to a point where we say we're going to issue two different types of stock. Whatever the two types of stock is, we're only going to issue it for one price. And it's that one price that's cash that we'll debit it for, just like here. And similar to last chapter, we'll also allocate it based on what we know in terms of fair value. But we're not on that part yet. So when we talk about issuing shares for $1 par value, if it's issued at $10 per share, we take the stock that's issued or the ownership that we've given away and simply multiply it by how much we're going to sell it for. In this case, it's 100,000 shares times $10 per share, and that equals what? $1 million worth of shares that's issued, okay? That's in terms of cash received. And we are the ones receiving the cash. Think about it, it's our company, so we are receiving the cash. Obviously, as I just said, we debit the common stock at the par value. So now, anything over and above what we sell it for is going to go to an account called paid in capital. Paid in capital in excess of par. Okay. Sometimes you may see something called additional paid in capital. Just keep that in mind when you're studying for your CPA exam. But the main thing is paid in capital in excess of par. If I were you, even though they don't do it here, make sure you may put in parentheses common stock or C/S. Anything to help you remember what it's going to go for. Okay, because that's going to be very important. Now, in the second part of the example, we see the entire proceeds from the sale of no par stock are deemed as stated capital. So what's the difference between par value stock and no par stock? With par value stock, we're always going to debit common stock at the par value. With no par stock, whatever you sell it for, that's going to be both the cash you receive and the par value. Okay? Does that make sense? There's no excess of par. So good way to think about that. If you have a test question, I always hate to say I'm asking test questions, but when we think about it, we learn a little bit more that way. If you see all of this set up here and they ask you, or they just ask you, if you sell common stock that is no par, how much is the excess of paid in value? How much is the paid in capital excess of value? There's never going to be anything excess because the no par stock is only issued at what it is, which kind of just confirms what you were saying. There's never an additional paid in capital for that common stock for no par common stock.
The par is basically what the
Yeah, let's don't say value because if you say value, then you start thinking of fair value. Okay, so par value is what the company lists it at. For instance, sometimes you'll see maybe. You don't want to say contract. It has, and let me read to you exactly what it says. It makes sense. Another prevalent practice that has little significance, other than historical significance, is assigning a par value to stocks. It's not even something we use a lot of anymore.
They just assign a par value to it, like when they decide they're going to go public, like way before they do, just to have a value back.
Right, and maybe stay away from that word value because then it's easy to confuse it with fair value.
They have to have a par.
No, you don't have to have a par value. That's where the no par common stock is. You don't have to have a par value because what happened, people may start kind of trying to sue you in terms of, no, this is the value of it. No, that's not the value. The par value is just a historical thing that is assigned to it. Historical, I mean, they did it a long time ago, not so much historical in terms of now. But sometimes they continue to do it, sometimes they don't. But if you see no par stock, you don't ever see anything with the par value. It's just whatever the list price was, whatever the selling price was. Okay. Good questions. Any more questions about that? All right. So that's the concept of par value and why we issue it. But let's say, for instance, I issue a portion of your ownership. I issue a portion of ownership based on something you did for my company. Say you're a lawyer, or say you build a wing onto my building, and I say, well, I don't have any cash to pay you, but I tell you what, I'll give you a portion of my ownership in my company. How do I value that? How do I value your law services? Or how do I value the stock better that is issued? I value the stock issued based on the fair value. Now we're talking about value. Based on the fair value of what your services are. Okay, so how do we determine fair value? Here are 5, and that is not just 5, but 5 commonly used factors that we can use to value fair value. A quoted market price for the shares. So look and see how much the shares are going for. The selling price of in a recent issue. We kind of talked about that last time, shortly after bonds were issued. So you may see something shortly after the shares were issued. The amount of cash that would have been paid for a cash purchase or the asset or service. So what would I have paid you for the law services? If I had the money or if I chose to pay you, how much would I have paid you, for your law services? An independent appraisal. That's another way of doing it. You get someone else, but in previous textbooks, that kind of moved away. That was less reliable. So kind of keep that in mind. I'm not saying that this is in terms of most reliable to least reliable, but when you study for your CPA exam, you may see an independent appraisal is a little bit less reliable than some, at least in the Wiley textbooks that we used to use. And other available evidence, of course, that's just getting further away. Okay. So let's look at the example here. This chemical company issues 1 million shares of $1 par value. But we don't have a cash price that's available. But when we looked in the Wall Street Journal, we saw that the shares of stock of the chemical company were selling for $10 par value. So what do? Number one, always, if there's a par value, always credit common stock at par value. Okay. In terms of the property, plant, and equipment. Now, why are we debiting that property, plant, and equipment? Because that's what is being given up. Okay, so the property, plant, and equipment is the value that you're going to trade in for your total amount of your shares of stock that you issue. And the paid-in capital is going to be the difference between the fair value of the asset and the actual common stock. In this case, is $9 per share, or $9 million if you want to kind of go out to millions. Okay. So issuing shares for non-cash stock, we always value it at what? Fair value. And still, the common stock is credited at the par value if it's there. Of course, if it's no par stock, then you would just say the fair value of the asset, and then the actual par value, the actual stock is going to be issued at whatever that total value is. Okay. Yeah. Oh, yes.
But what if it doesn't give you the par value? Would it still be the same property, plant, equipment that paid it?
Yeah. In this case, it would just be common stock, $10 million, if there were no par value. Okay. Yeah. So it'll be just like no par common stock. Mm-hmm. And those are good questions. Like say that in real life, you still see, especially some of the older companies, they still have their little par value symbols, but depending on now, they may or may not have it. So just kind of be familiar with it. And like I say, as a new accountant, I don't, especially like say you're talking about a big 4 firm, I don't think you'll be thrown into working with all of those types of accounts, but you may be called upon to do some things, and definitely in your CPA exam, those are two types of questions you will see. Okay. Now, similar to last time, you remember when we issued bonds with warrants, and we could value the warrant differently than the actual bond? Well, we have the same procedure here that we do it when we're issuing more than one security issued at a single price. Number one, always debit cash for whatever the amount of cash that you're bringing in. Because remember, you issue stock or you issue equity in order to raise capital. So debit the cash for whatever you're bringing in. Then you look to see if you have one or two fair values. In the example here, you only have one fair value, okay? So what do? You take the fair value of what you have, debit that particular security, and credit the additional paid-in capital for that amount. And then for the remaining share of stock or shares of stock that you have, that's what else goes to that. And let's look at it in terms of this example. There are three things happening in this example. AP&P issues 4 million shares of common stock. You see that? And of course, they're talking about AT&T, right? You know, they just kind of couldn't plagiarize or something like that. So, AP&P issues 4 million shares of common stock, $1 per share, and $4 million of its preferred shares, $10 par value, for $100 million. So we see the intent of this stock issue is to raise how much money? $100 million. Therefore, we'll debit cash for $100 million. We're good on that part? I maybe will put number one there. Debit cash for what you receive. Number two, I need to find out if I have one or two fair values. Let's keep reading. Today's issue lists the common stock at $10 per share. That's good. I know what the common stock is. There is no established market price for the preferred shares. So now I know that step two, I have one of the securities I could value, $10 per share. So I will now assign the amount to what I have. I debited the cash in step one. Now, for step two, common stock, $10 per share. We know I always credit common stock at what? Par value. So common stock is going to be credited at par value. The par value here is $1 per share. So anything over and above that $1 per share is going to go into what? Paid in capital dash common stock. They put comma in here, whatever you want to do to keep up with it, okay? That took care of the allocation for what I do know. Now, the remainder of the entire issue goes to what I didn't have, which was the preferred stock. How do I do that? Well, I always credit the preferred stock at par, right? And now truly the remainder of what you have is going to go to the paid in capital preferred stock. Okay, so 3 steps. Debit cash for whatever the amount of cash you receive. Number 2, find and allocate the amount of cash to whatever you have there in terms of what you know. For instance, if you have common stock, credit common stock for what it should be, and the remainder of that particular issue goes there. The difference between the 10 and the 1, the 10 and the 4, in this case. All right, and the remainder goes to the preferred stock, always crediting the preferred stock at par value, and then the remainder goes there. 3 steps. Any questions?
So the no established market for the preferred shares, that's basically what you're finding?
Say again?
Because it says there's no established market for the preferred shares.
Right. So everything left over after I do my common stock allocation goes to the preferred shares.
And it could be the same if it says there's no preferred market for common shares.
Exactly.
So you can,
Exactly. And what do you do in that case? You take care of the first part, but remember, you always credit the stock at par value, and then the remainder goes to it. So truly the remainder goes to the paid in capital. Okay. Just similar to last time with the long-term bonds and warrants issued separately, same concept here. Okay. And the final thing we have here in this small section is share issue costs. Okay. With share issue costs, that's talking about anything that you use to get the share ready to be issued. Some of those listed here are legal, promotional, and accounting services. We all know about those, okay? How do I value that? Well, the actual amount of that is going to reduce the amount of the paid-in capital. Now, the example here you have is that they're selling something for $136.1 million. We see that we only collect cash of $127.6 million. I know that's what it is for cash, but when you are confronted with a question, what does it do? One of the answers I'm quite sure would be it reduces cash. But truly it doesn't reduce cash. It reduces the amount of paid-in capital in excess of par, which means that the cash itself is going to go down because common stock or whatever stock you're issuing is always going to be credited at par. So the true reduction comes as a decrease of or reduction of the paid-in capital in excess of par.